Hello and welcome back to the vlog. We are going to jump in. Actually, chapter 4. Hooray! We made it past the chapter. I just walked out of the apartment with my shirt on inside out. So just pretend you don't see that, and we will continue. All right, cool. So chapter 4. Chapter 4: Gaining critical advantage from indicators. Indicators are a shorthand way to identify and measure market sentiment. They give you a platform for making rational trading decisions, bypassing greed, fear, and the other emotions that accompany trading. Technical traders believe that systematic trading has a sporting chance of making significant profits. That's the second advantage of indicators. They identify conditions based on data and by having realistic expectations about how well indicators work as forecasting tools. You're led to having trading rules that offset indicators' shortcomings. And indicators have shortcomings. They don't always work, and I explain why in this chapter. To overcome the unreliability of indicators, a money management plan is necessary. Trading is about money, and money arouses emotion. The shorthand description is greed and fear, but those terms aren't enough. Trading is also about personal success and failure. You'll be able to fend off the emotional roller coaster that trading can set in motion after you figure out how to attribute gains and losses to your tools, the indicators, rather than to your own identity, brain power, and character. After you become proficient at technical analysis, you'll feel chagrin. I have never come across this word. chagrin at losses instead of screaming anguish and falling into the slough of despond. That's just seems like a weird sentence altogether to me. Yeah, all right, anyway. Your mind will be clear enough to judge whether the indicator failed or the market was abnormally weird, and whether you may perhaps need to tweak your indicator set. Likewise, when your indicators deliver winning trades, you can credit having found a successful methodology, not imagine you have superpowers. You'll see promotions for indicators and trading systems that never fail and will make you a fast fortune. These promotions are never true. The promoter got lucky on a small number of securities over a short period of time, and his ego got too big for his britches. Indicators are notoriously unreliable. The true secret to successful trading is to accept indicator unreliability and to take steps to offset that unreliability with good trade management practices. The purpose of indicators is to separate the signal from the noise. Indicators are based on price and volume data, and data can be noisy. To get a grip on noisy data, check out Nate Silver's book, The Signal and the Noise: Why So Many Predictions Fail But Some Don't, Penguin. Okay, Silver writes about polling data, including political polls, economic forecasting, and business data like sales forecasting, but the principles are the same as for the predictive value of indicators. Data is data, and all data is dirty. Ooh. All right, indicators are a substitute for that miraculous ability some few persons have of being able to get in sync with the market. To be in sync means you know intuitively exactly what's going on and where prices will go next. You're on the same wavelength as other market participants. Such unquantifiable insight is more art than skill. Leo Tolstoy, when answering the question, "What is art?" said, "It's a mean of union among men, joining them together in the same feelings." This is exactly what you have, a form of union with other traders when you are in Zen-like harmony with the market. You might be lucky enough to get in sync with the market sometimes, but don't count on it. Count on indicators despite their shortcomings. This chapter gives you the lowdown on indicators, including what indicators are, how they work, and what you need to know when choosing which indicators to use. Every price series, trending or not. Overcoming noise. Every price series, trending or not, has a certain amount of noise. Noise refers to price changes that arise from unforeseen quarters, can't be forecasted, and tend not to last. The causes of noise vary from security to security and over time. Noise seldom changes a trend already in place, but it can mess with your indicators enough that you'll get false signals. Technical analysts like to draw a difference between noise and a market-moving event, which I like to emphasize with a capital E. An event is generally more than just another bit of news in a series of news. It's a game changer. Distinguishing between noise and an event. The difference between noise and a genuine price event Consider in the foreign exchange market, you sometimes get a 1,000 point move in a single day when the average daily range is 120 points. A move of this magnitude isn't noise because noise implies a minor price move with rapidly diminishing reverberations. The 1,000 point shocker is an authentic price event and almost always signals a major change in trend or starts a trend from a state of untrendedness. In equities, ordinary noise can be an earnings announcement that is different from the earnings guidance that the company or analyst told the market to expect ahead of time. An event would be an unexpected massive loss. In foreign exchange, ordinary noise is the release of the payrolls report. An event is the United Kingdom deciding by referendum to leave the European Union. Fair enough. Note that a barrage of noises, however, can become an event even though no single component is more than noise. Famous economist Fisher Black said noise is when a large number of small events has a more powerful effect on prices than a small number of large events. In other words, be wary of dismissing an inexplicable price move as only noise. Noise can rule the roost. You may still want to try to distinguish between events and noise because events change prices for sure, and with noise, you never know. One useful clue that ordinary noise is actually an event is to compare the news release with what had been expected by experts, which is named a surprise index and can be found in various formats. Comparing actual to expected takes you back to the realm of fundamentals, but may give you an edge when you see prices on the chart behaving abnormally. Knowing where noise comes from. Noise arises from news and can be big or small. Big news includes a stunning reversal in an economic trend, a revolutionary product discovery, or a meaningful change in sales and earnings from previous guidance. Smaller news is a smaller change in an economic trend, the appearance of a long-awaited product development, think Apple, or a minor change in sales and earnings. Some analysts think noise is always external to the security, whereas others think noise can just be as easily inherent to the security's core conditions. An example is a change in a company's dividend policy or a plan to execute buybacks. Noise also comes from big market players changing positions as a supply and demand factor. Perry Kaufman, author of the Encyclopedic Trading Systems and Methods, John Wiley & Sons Incorporated, now in the 6th edition, says that noise is a difficult concept. He pictures noise as raindrops falling on a pond, causing what looks like random ripples. The interesting thing about market ripples is that markets adapt to them, and they stop being shocks and become normal, losing their power to change prices. What's the relationship of noise to randomness? A lot of what is considered noise isn't really a surprise and not really unforecastable. For example, you get the US non-farm payrolls reports on the first Friday of every month. You know it affects many market prices disproportionately. What you don't know is in what direction. Often you know payrolls will likely cause price spikes in both directions, but the spikes aren't forecastable as to extent or duration, let alone which direction comes first. The spikes are noise and certainly reflect shock, but they aren't random. Some noise, however, is truly random. Uncle Fred decides to sell 100,000 of shares of Blue Widget to buy a yacht, and his decision has nothing to do with the valuation of Blue Widget. Imagine that 100,000 shares is a relatively large amount for Blue Widget. Other traders assume there's a story behind the price drop and jump on the selling bandwagon, inflating the volume and taking the price far lower than the original 100,000 shares would have done. This is why it's not wise to couple the word random with noise in all cases. Noise from inside the market. Noise can arise from traders trying out bizarrely off-trend price, which is mischievous and at the far boundary of the price discovery process. One subset of noise traders are the high-frequency model-driven traders whose computers spew out thousands of bids and offers, virtually none of which get filled, trying to get a rise out of the unwary. Another subsequent of mischievous traders is named noise traders by academic economists, a class that includes traders driven by ideology rather than information. Noise traders, also called uniform traders, are often contrarian, and academic studies find they tend to lose money in both noisy and non-noisy market conditions. From the view of the single security, what the overall market is doing is an external factor. But as Chapter 3 shows, as much as 25% of a price move in a specific security may be due to the effect of changes in the index or class of securities to which it belongs. The fundamentals that move the index may or may not affect the security, but it gets saddled with the effect anyway. A non-trending price series is especially vulnerable to random inputs that move the price disproportionately to what rational analysis would say real cause and effect ought to be. The shorter the time frame you're looking at, the more influence noise has on your indicators. Noise, random and otherwise, is one of the main reasons why untrended price moves are susceptible to false breakouts, but trended price moves aren't immune either. All right, cool. So when we come back, we'll talk about indicators that give you an edge, classifying indicators, and more. Thank you for joining. I'll see you next time.